Good morning. And I just want to make a very quick announcement before we get started. There's an ABS conference coming out on Friday, right before Stern Follies. It's basically a speaker series of international folks that are coming to NYU to talk about what are Asian companies doing to break into the US market. So if you open up any newspaper or magazine, you can read a lot of articles around what are Western companies doing to break into China, right, to break into Asia. But you can't read a lot about what are the big Asian conglomerates doing, so not LG, not Samsung, but the ones you probably have never heard about, to break into the US, into Europe. So that's what these speakers are gonna talk about. So if you're interested, check it out on Campus Group. I can't pull it up here, but the folks from ABS are gonna sell tickets outside during lunch, and also check it out on Campus Groups. It's only $10. It's right in front of Stern Follies, so you're gonna be here anyway. So please check it out. Thanks.
Your coffee. Where is everybody? Where? It's raining, it's Monday, it's 4:20. I can't wait for you guys to actually start on your jobs. That'll be fun to watch, right? I mean, it's... Okay, so I hope you got the... I know you're getting the emails, so I'm not saying I hope you got the emails. I hope you read the emails I sent over the weekend, because I've actually collected the stuff that you need to do on the project on one page with all the links you need, so you're not, And that'll, as I said, that process is going to keep kicking up exponentially. As I said, I'm going to drag you over the finish line, whether you want to or not, okay? And it's going to take a little more dragging with some of you than others, but how many of you have actually done the optimal capital structure for your companies? Okay, good. At least we have somebody who's getting started, right? So you have an optimal debt ratio of your company, and what I'm going to start with today is actually that framework I ended with last session. I'm going to take Disney through that framework, and what I'd like you to think about, if you have the optimal debt ratio for your company, is start thinking through what you would do with your company, right? So I know it's distracting to think about a different company, but it's the same framework. So as I said, when you look at your company, one of three things is going to be true. It's either going to be under-levered, too little debt, over-levered, too much debt, or just enough debt. Now, called it the Goldilocks solution, right? If you have the Goldilocks solution, just let it go. But if you're looking at under-levered or over-levered, we looked at a framework of whether you need to act quickly, which is going to depend on whether you're under threat of takeover if you're under-levered, or threat of bankruptcy if you're over-levered, and if you have good projects that allows you to complete the process. So I'll take Disney through the framework, and as I said, think about your company. Right? So to me, Disney looks under-levered. Remember all the different approaches, 7 different approaches, all of which delivered a debt ratio higher than the current debt ratio. The current debt ratio is about 11.5%, the optimal is 30, 40%. So it's under-levered. First question I had to ask myself is Disney potentially the target of a hostile acquisition? What are the 3 things I should look at to make that judgment? One is the size of the company, which is about 130 billion plus, so consider that a strike against. It's not Google or Facebook, it's not as big as those companies, but it's still in market cap terms a pretty big company. So that's going to make it tough. The second I said is look at the insider holdings. Look at the top 17 stockholders to see if it's going to be easy for you to get to 51%. Again, this is not a Google where you have a Sergey Brin and a Larry Page right there up in front saying you can't do this with voting and non-voting shares. But you do have 2 big individuals on that group, right? Remember the top 17 investors in Disney? Who were the two individuals who showed up? One was Laurene Powell Jobs, so it's Steve Jobs' widow. And the other was George Lucas. Now the question you've got to ask yourself, are they going to be my allies or my enemies if you try to take over Disney? Right now, I'm not sure they're going to jump in with you because they look like they're okay, but who knows? No, that might change. So second strike. Third, what what's the last thing we looked at to make a judgment as to whether your stock company was a potential target? I said, look at your Jensen's alpha, which is just a fancy way of saying, is your stock a good investment or a bad investment? Has it made stockholders happy over the last 2 years, the last 5 years? And I know you don't remember with Disney, but when I did this way back 5 weeks ago for Disney, the Jensen's alpha that I came up with for Disney was about 9.5% a year. It's done better than the rest of the market, the rest of the sector over the last 2 years. So in 2014, the judgment I would make for Disney is no. It's not the potential target of a hostile acquisition, which means I have the luxury of time. I still have debt capacity, but I don't have to do anything overnight. Then I asked myself a second question. Does the company have good projects? And again, asking the company whether it has good projects is kind of silly. So I looked at the evidence. And here again, based on something we did a few weeks ago, I came up with the return on capital for Disney, which was much higher than its cost of capital. I think the return on capital we got is about 4.9% higher than the cost of capital. At least based on their existing investments, it looks like Disney has good investments. So you have excess debt capacity, you have good investments. To me, the solution, at least going forward, seems to be to give Disney the leeway to use its debt capacity to take those good projects. And remember the benefit you get there. Not only does your value increase because you're going to your optimal, but you also get the net present value of those good projects added on. That, to me, seems like the optimal solution here in 2014. I told you this was also the 4th edition of my book, to show you how my thinking on Disney has evolved or changed over time. The first time I did this in 1997. Disney was a $70 billion company, which at that time was a big market cap, with a positive Jensen's alpha and a pretty good performance record over 10 years. The only strike it had in 1997 was that its CEO was an absolutely obnoxious dictator. But we're willing to live with dictators when things are going well. So in 97, I said, you know what? Disney is not the potential target of a hostile acquisition. My second time, I think the second edition was 2003 or 2002. And between 97 and 2002, Disney had managed to destroy half its market cap. In fact, between 97 and 99, much of this happened, which, as I think I've pointed out before, is a really tough thing to do when the rest of the world is going up by 400% to knock your value down by 50%. But Disney pulled it off. Partly because an acquisition they made in 96 with Cap Cities didn't really work out by the time you got to 99. So if you'd asked me in 99, and in fact right after the 97 edition of the book came out, I bought 1,000 shares of Disney because I wanted to feel the pain, and I felt a lot of pain. And my vision of a good day in 99 would have been to wake up, open the paper and see eToys announces hostile acquisition of Disney, just to see the looks on people's faces. Because it looked to me, at least from the outside, that the company was in denial. And you could see this building up, 99, 2000, 2001. Each year you could see investors getting more angry at what Disney was doing. So in 2003, if I were looking at Disney, my conclusions would have been very different, because the company had become a much smaller company in terms of market cap. Its Jensen's alpha was a negative number, and the CEO of the company was the same guy who got Disney into trouble by telling me, hey, trust me, I know what I'm doing, when he bought Cap Cities ABC. In fact, you could tell that Disney was getting a little worried about stockholders getting angry. And here's how you could tell. Michael Eisner started talking about how much he cared about stockholders. This is Michael Eisner. Okay? In fact, that's usually a giveaway when CEOs are scared, and they talk about how much they care about stockholders. I remember, in fact, a session I was master of ceremonies of, something I've tried to avoid doing because you can never say what's on your mind. You've got to be polite to everybody coming through. So this was late 99, right after Telecom Italia had been targeted in a hostile acquisition. The reason I bring that up is until Telecom Italia was targeted, European companies used to think they were immune from hostile acquisitions. They thought that this was an Anglo-Saxon phenomenon and that this would never cross the borders. I mean, these were uncivilized actions. You couldn't see that in civilized Europe. Telecom Italia goes through a hostile acquisition. It scared the heck out of CEOs in Europe. So they have this conference of CEOs on corporate governance, and I had the misfortune of actually sitting right next to the CEO of Siemens at this Geneva conference. So he gets up and he starts talking about how much Siemens cares about stockholder wealth maximization. I almost fell out of my chair. Because this is a company that's treated stockholders like mosquitoes for a century. Here, take a dividend, get out of here. And he was talking about, listening to him talk about stockholder wealth maximization, I had the same sensation I had when I heard Madonna sing like a virgin. To which my response is, how would you know? What is this, a deeply repressed memory you're pulling up? So listening to some CEOs talk about stockholder wealth maximization, you know that they're not doing it because their heart's in it, but because they're scared. But look for small codes like that. If your managers are very intent on saying how much they care about stockholders, something is happening behind the surface that's scaring them. So all I'm trying to say is you can have a company go through cycles. You can be a company that has a lot of freedom, a lot of flexibility, like Disney's in 2015, because it's done well. That's the key. You earn the right to be free. And in this case, Disney's earned the right to say, look, we'll take our time doing what we need to do. So at least in 2015, my judgment for Disney is, hey, you have debt capacity, you have great projects. Do what you want for the moment. But it's a temporary reprieve. If they start to take terrible investments, they start buying up companies right and left, and they start destroying value, 3 years from now, they can lose that freedom. So it's a point in time and a company. No company gets the freedom to do whatever it wants in perpetuity. But for Disney, at least in 2015, that would have been my final conclusion. So here's what I want you to think about. After you have the optimal for your company, sit down and think about, do you need to do something quickly? So if you're under-levered, look to see where you're the potential target of a hostile acquisition. Size of your company, insider holdings, Jensen's Alpha. If you're over-levered, look to see whether you're under threat of bankruptcy. Look at your actual or your synthetic rating. Look at your interest expenses. See if you're in trouble. But look at news stories as well, because they will give you an indication. Ask yourself, do you have to do something quickly? If you have the luxury of time, you don't have to do something quickly, then ask yourself the follow-up question. What can I do to bring my debt ratio up or bring it down? Right? So that's when you look at what kind of projects do I have. Can I take projects over time, if I have good projects, with debt or equity to change my debt ratio? If you don't have good projects, then you're stuck doing what we talked about, a recapitalization where you're borrowing money to buy back stock or raising equity to pay down debt. Effectively, you're playing with the balance sheet. So if I were to draw a picture of what your choices are, if you have a company that's over-levered, remember the tougher problem to have? To decrease the debt ratio, you have to either sell assets or use cash to pay down debt, or you can issue new stock. Either way, you are lowering your debt ratio. Right? If you want to increase your debt ratio, you can sell operating assets and use the cash to either buy back stock or pay a dividend, which reduces equity, or you can borrow money and buy back stock, which is a recapitalization. Which path you adopt will be specific to your company. So even within your group across 6 companies, even though they might be all under-levered, you might have different choices you make depending on the company you're looking at. Any questions on moving from the optimal to what to do next?
I have one question about taking new projects.
Right.
Reducing the ROC to meet the determination.
Yeah.
So aren't we looking at the past to...
That's a good question. The question was, the ROC tells you how good your past projects are, right? The question you're asking is about future projects. We are making a leap of faith in assuming that if you have a history of taking good projects, that you will continue to do it. That's why I said it's a temporary reprieve. You've earned that, because in a sense, nobody can prove. If you say, prove to me that the project is a good project, what are they going to show you? Projected cash flows and IRR? You have to go with the track record that a company has. Okay? But you are, in a sense, watching. You give them the right to take those projects, but you watch how well they do, because you are willing to extract that right if need be. Okay? Any other questions? So that's the key if you want to do something quickly. If you want to do something gradually, things get a little messier. And here's why. If I ask you, how much would you need to borrow to get to a 30% debt ratio today? It's simple, right? You take the value of the firm, you take 30% and say, that's what I need to do. But if you're targeting getting to 30% 5 years from now or 10 years from now, here's the problem you're going to face. To get to 30 or 40% 10 years from now, you've got to estimate the value 10 years from now. You can't take today's value. And if you're a growing firm, a 30% debt ratio 10 years from now is going to be a much bigger number than a 30% debt ratio today. So what you have to often do is forecast out the value of your company 10 years out, which is a little messier than estimating the value today. Estimate 30% of that number and then say, what can I do over the next 10 years to increase my debt ratio? So you get a chance, take a look at the book. It's really messy because you've got to do 10 years of projections. You've got to figure out, you've got to really play with different numbers. What if I raise my payout ratio to 40%, 50%? What if I buy back $2 billion worth of stock every year? And look at the end result that you will get. And you're going to be surprised at how much work it takes to change your debt ratio over time, because your value is changing and you're trying to change your debt ratio as your value changes. So again, make that choice up front. Do you want to do something quickly? Do you want to do something gradually? If it's gradual, again, ask the follow-up question. Do I want to do this by taking projects or by recapitalizing? And make the judgment that's right for your company. So that's pretty much getting to the optimal. Now let's assume that I sell you on this notion of raising your debt ratio from 15% to 40% your Disney. And you ask me a question. You say, okay, you've convinced me. I want to borrow money. What type of debt should I use? It's at this stage in the process that if you're a part of a corporate finance team at an investment bank, you make a fatal mistake. You say, look, that's not our job. The product people will be around 2 weeks from now to talk to you, and you leave. You know what's going to happen the minute you leave? The CFO now knows he has excess debt capacity. You've convinced him of that. Your product team is going to come back in 2 weeks with all their neat products that you can use. He's not going to wait for just your product team. He's going to put a call out to 4 other investment banks, and the next thing you know, you've done the dirty work of convincing this company that it has excess debt capacity, and somebody else walks away with the spoils. So if you're ever asked, what type of debt should I use? By any business, small or large, public or private, rise to the challenge. It's not that complicated. We've already laid the foundations, but let's start to build on it. What's the best thing about using debt? What's the biggest advantage of using debt? A tax benefit, right? What's the biggest advantage of using equity? Come on, there's got to be some advantage. What's the advantage of using equity? It's flexible, right? It's flexible in what sense? If you do well, you can pay a dividend. If you don't do well, you don't have to. You can't be sued for not paying a dividend. So the biggest advantage of debt is a tax advantage. The biggest advantage of equity is flexibility. Wouldn't it be neat if you could issue a cross-dressing security? Visualize it, a cross-dressing security. What do I mean? This is a security that acts like debt with the tax guy. It gets you the tax benefit, but acts like equity around you. In other words, it gives you the benefits of both. It gives you the flexibility of equity with the tax benefits of debt. That's going to be the end game we're going to use for the next hour or so to design the perfect debt. And here's why it's going to pay off. Think about a firm whose value goes up and down. Why? Because this morning I was valuing Lukoil. As oil prices go up and down, the value of the company goes up and down. Not because it's a badly managed company, but because that's the nature of the business. If you're valuing a cyclical company, your value will go up and down depending on whether you're in a recovery or recession. If I went out and borrowed money and that debt had a fixed value that I had to pay no matter what, this company is in trouble. Do you see where? Whenever the value of the business drops below the face value of the debt, I am technically bankrupt. So what's the most you can borrow? Well, I'll have to look at the lowest value I can get as a company and borrow below that. You think that's always the case with borrowing? Not necessarily. Assume you could issue debt that has the following characteristics. Its value actually goes up when the value of the business goes up and down when the value of the business goes down. Think it's impossible? Leave that to me. We'll try out different things. Maybe we can pull this off. Do you see the advantage you get? This company actually has 1.5 times more debt than the previous company in the previous page, but this company never goes bankrupt because the debt value kind of matches up to the equity. In practical terms, here's what I'm trying to come up with? I'm trying to come up with debt where the cash flows on the debt are high when my cash flows are high. But if my cash flows drop off, I want the cash flows on the debt to drop off as well. What are the cash flows on debt? Interest payments and principal payments. If I can somehow tailor your interest payments to be high when you're doing well, and contractually allow you to drop the interest payments when you're doing badly, you get the best of both worlds, right? You get the tax benefits of debt and the flexibility of equity. So we're going to design the perfect debt for a company. And I'm going to do it in the abstract using my examples. But here's where you can start on your project right now. You don't even have to have gotten to the stage. If you know what your company does, and I hope you do, we should be able to design the perfect debt for your company in the next 45 minutes. So here's the first thing we're going to do. I'm going to be a debt designer, you be the company. In order to design your debt, I need some information from you. You see why? Because you know your business better than I do. So here's the first question I'm going to ask you. I'm going to ask you about what a typical project looks like for your company. I tried to get you to do this 3 sections ago, but if you haven't got to this, start thinking about what's a typical project for your company. So let's take a couple of examples. I'll use them as examples to kind of bring this home. And you start thinking about your company. Let's take Boeing as my first example. What's a typical project look like for Boeing in terms of duration? I mean, Boeing collectively has, 8 projects in its entire lifetime. The 707, the 727, the 737, the 747, the Dreamliner. You know when they started working on the Dreamliner? The R&D was probably, the 1980s. They started the R&D. So you did about 20 years of research before the first plane rolls off. And the first plane rolls out, it has all kinds of issues. Things start to catch fire, this, that. So it takes about 5 years for you to clean up all that stuff. So 25 years after you started the research on the plane, finally you're selling a lot of Dreamliners. And you continue to sell them for decades. The last 747, the big jumbos, the last 747 rolled off the assembly line 30 years after the first one did. So if you're lucky with the Dreamliner, your last Dreamliner might be rolling off the assembly lines in 2040, 2041? A typical project for Boeing is going to be 50, 60 years. If you take from the start till the very end, so you think, so what? So you be the debt designer for Boeing. What kind of, in terms of maturity, what type of debt should they have? Long-term debt or short-term debt? Really, really long-term debt, right? In fact, Boeing was one of 2 companies in the late 90s that issued 100-year corporate bonds. Think about it, 100-year corporate bonds. You know what the other company was? It was Disney. Interesting choice. We'll come back and look at we can see why it makes sense for Boeing. We'll come back and see what part of Disney it might make sense for. So for Boeing, the debt should be really long-term debt. In contrast, let's say you're Google or Facebook and you're borrowing money. What's a typical project for you going to look like? The R&D is not going to last 20 years because if you take 20 years, the entire market's gone from you. So you're probably looking at 3 to 6 months of R&D. Product comes out. 2 years later, the product is already obsolete. You're looking at probably 3 to 5 year projects. The typical project for a technology company where everything is changing quickly might be 3 years or 4 years, short-term debt. Now, the reason I picked those 2 is their typical project was a typical project. Saying, what if I'm GE? What's a typical project look like for GE? It depends on what part of GE you're looking at, right? It could be GE Aircraft, GE Household, GE Capital until recently. If you have a multi-business company, and with Disney I have a multi-business company, it'll mean taking each business and asking this question, what's a typical project in Disney movies? What's a typical project in Disney broadcasting? What's a typical project for Disney theme parks? And what's a typical project for Disney Interactive? Very different answers, which effectively means the right type of debt for each kind of business is going to be different. So what's the first question? The second question I'm going to ask you is what currency your cash flows in? So if you were Coca-Cola and I asked you this question, you're going to show me a pie chart, right? I get 45% of my revenues in US dollars, 25% in euros, 15% in Chinese yuan, 10. So that pie chart comes from where you make your money. So if I'm designing the right debt for you from scratch, the pie chart for your debt in terms of what currency your debt should be in should very simply reflect what your revenues are. You're saying, but, there are lots of buts there, right? We talk about taxes, we can talk about friction, some markets you might not be able to borrow at. For the moment, don't even think about what the constraints are. Think about designing the perfect bond. Then you can bring in all the frictions in the marketplace and say, what do I have to change? So your currency on your debt should reflect the currency in which your projects deliver their cash flows. Third question I'm going to ask you is, how does inflation affect your cash flow? Sounds like a stupid question, right? The question I'm asking you is, do you have pricing power as a company? What does that mean, if you have pricing power? If you have inflation, your costs go up, and if you have pricing power, you can pass those costs on to your customers. You're saying, why should I care about that? If you have pricing power, I think you're a much better candidate for floating rate debt, and let me explain why. How does floating rate debt work? When the base interest rate, LIBOR, whatever you've said, goes up, your interest rate goes up with it. When that base interest rate goes down, your interest rate goes down with it. What's that got to do with inflation? Inflation is if inflation goes up, the conduit through which it shows up is interest rates. Higher inflation means you have higher interest rates, right? If you have pricing power, you have no problem with floating rate debt, because when inflation goes up and interest rates go up, what do? You pass the cost on to your customers. But if you don't have pricing power, think of what happens to you when there's lots of inflation. Your costs go up, right? Think of an airline that's not able to set prices. Your costs go up because fuel prices go up. You can't pass it on to your customers because you have no pricing power. So actually when inflation goes up is when your earnings are smallest. And if you have floating rate debt on top of that, you're going to put yourself in double jeopardy. You're going to be making these big interest payments in the years in which you can least afford it. So when I ask you how does inflation affect you, that's why I care, is because it'll tell me whether I should be issuing fixed rate debt or floating rate debt. So I've got the maturity nailed down, I've got the currency nailed down, fixed or floating. The fourth question I ask you is, are you a mature company with low growth? Are you a growth company where your cash flows are low right now but you expect high growth? And here's why it matters. When you set a fixed interest rate up front, a fixed coupon, basically you have high cash flows which are set at that number all the way through, right? And if you're a mature company, that's not a problem. So if a Procter & Gamble issues debt, it should probably issue fixed rate debt because it has high cash flows now. It expects to have pretty much the same cash flows in the future. But if you're Tesla, and Tesla did borrow money, some of the money for the Gigafactory that they're building in Arizona, is that where they're doing it? They got that big tax break, $5 billion factory. If you're Tesla, your cash flows right now are not just small, they're negative, right? But let's say they're really small, which is true for a lot of growth companies even when they're doing well. When I borrow money, I want to keep the cash flows on the debt low right now because I can't afford big cash flows. But here's what I'm willing to accept. As I grow, I'm willing to accept higher cash flows on my debt, right? You know what the best feature of convertible debt is for a young growth company? Take a look at the coupon rate that Tesla paid on its convertible bond. It's 1%. You think, absurd. Why would I lend to Tesla at a 1% rate? You're not lending to them at a 1% rate. You're getting this huge equity option. That's a conversion option. You're willing to accept a lower coupon rate today, which means your cash flows are low up front when you're a growth company. As you go from being a growth company to a mature company, guess what's going to happen? Assuming you adopt the right pathways, your convertible debt is going to get converted into equity, and you can replace it with straight debt when you can afford the straight debt. So if you're a growth company, you're a much better candidate for convertible debt. That's 80% of debt design. We've got the maturity, we've got the currency, fixed or floating rate, straight or convertible. And then you can have fun. I know this doesn't sound like fun, but you can ask the company, what else affects your cash flows? Maybe I can build it into your bond to make it more flexible. And I'll give you a couple examples. You're a gold mining company. What's the biggest factor driving your earnings and cash flows every year? Gold prices. As gold prices go up, your earnings go up. As gold prices go down, your earnings go down, right? Wouldn't it be neat if you could issue a bond where the coupon rate was tied to the price of gold? Where when gold prices are high, the coupon rate is 11%, but if gold prices drop off, your coupon rate decreases with it. In fact, it was a gold mining company that issued the first commodity bond. It's called a gold-linked bond, where it tied the coupon rate to the price of gold. It's now part of a family of bonds, commodity bonds, tied to different commodities. And if you're a small commodity company, or even a big one, think of all those shale oil companies out there that are in trouble. Remember 2 years ago when everybody thought oil price was going to $125 a barrel? When those companies issued bonds, could they have tied the coupon rate to the oil price? They might have had to pay a slightly higher rate up front for doing it. But people would have lent to them because they thought, the people lending money to these companies also thought oil price was going to stay at $125 a barrel. And now that oil prices have dropped to $45 or $50 or $55, if your coupon rate were dropping with it, you wouldn't be in the trouble you're in now. That's what you're trying to build in. This isn't a free lunch. You're not trying to fool anybody. You're just saying, I want to share my risk with you, and in return I'll give you a higher interest rate. So that's a gold-linked bond. Here's a second example. About 15, maybe 16 years ago, somebody went through this class, graduated, which is usually what happens to people who go through this class. Now, so I'm not telling you the bad story. This is the good story. Ended up at Allstate Insurance, their finance department. So a few weeks into her job, she calls me all excited. She says, I've been looking at the numbers, and I think we have a lot of excess debt capacity. And I said, what exactly are you doing? He said, I'm plugging the numbers into the optimal debt ratio spreadsheet we did in corporate finance, and it looks like Allstate should be at 40% debt. They're at 6% debt. So what do you plan to do with this? He said, I'm going to present this to the CFO and see what he thinks about it. So a few weeks later, she calls me completely forlorn. She says, I presented the CFO, and CFO didn't particularly care for it. So what do you mean? She said, when I told him that Allstate had excess debt capacity, the CFO said, we know. I said, okay. So why do you ask? And so she said, then I asked him why you keep the excess debt capacity. And here's the reason he gave. He said, we know we have excess debt capacity at the earnings and cash flows we have, but we're always one disaster away from bankruptcy. See what he was talking about? If you go to the 40% debt ratio, you look nice and healthy right now, but you have a Katrina. In 2005, every insurance company had to pay out billions of dollars. There goes our buffer. We can't borrow money because we're one disaster away from default. Makes sense, right? Can you design a bond for an insurance company that is worried about this disaster possibility? In fact, let's design the bond from scratch. You issue the bond, there's a coupon rate set on the bond, right? And you're willing to set the coupon rate, whatever number the market demands. But in the event of a disaster, what would you like that coupon rate to become? Maybe 0 for 3 years. Maybe even adjust the principal. And remember again, there's no free lunch. By doing this, you give up a higher interest rate on the bond. Because investors, but here's what you're playing on. Everybody thinks they can predict disasters. Not everybody. There's a subset of the human race that thinks they can predict pretty much everything better than everybody else. You're taking advantage of them. So they're reading their farmer's almanac saying there'll be no hurricane this year, therefore I'm going to buy the bond. Go ahead. Let them use their false expertise to take a position on the bond. You're paying a higher interest rate on the bond. Maybe, and you're willing to accept that because in return, what are you getting? You're getting the flexibility that in the event of a disaster, you can still survive. These are called catastrophe bonds or cat bonds. They're issued primarily by smaller insurance companies because it's kind of silly for a large insurance company that claims its strength is predicting risk to turn around and say, we're going to pass it on to you. That's in fact, but the reinsurance business in a sense is born out of this. But smaller insurance companies are the biggest issuers of catastrophe bonds. But what I want you to think about is what we're trying to do in both cases. We're trying to design a bond that will protect you in case bad things happen to your operations. How does it show up? It shows up as, first, a lower default risk for any given level of debt, which then translates into a lower cost of debt, a lower cost of capital, and a higher value for the firm. Yep. Why does they, I'm sorry? Defease their bonds? I've no, they're not liable for what? They're not, don't
The company goes bankrupt, the debtors don't have
claim on the assets?
yes, the fees.
Okay, is that what, I'm not even familiar with this. Okay. I mean, if in fact that's the case, then I'm not sure that you could pass the tax guy's test. Remember, there are two tests. In fact, that's going to be the next issue you're going to face, is if you try to be too clever about designing debt that behaves like equity, you know what might happen? When you go in front of the IRS and say, look, we're going to treat this as debt, the IRS says, no, it looks too much like equity. So I'll check, I'll check to see, I'm not familiar with too many big name companies that have done this. Maybe it's smaller companies that do it. Eh? Oh, these are issued by state and local governments? Is that what it is? Then I'm not even sure how we deal with that, right? It's in a sense, it's because you can't be taking the bridges over. I guess there's some legal protection to get. It might be very specific to the state municipal bond market. If you're if you're a profit-making entity, generally if you borrow money, those guys have claims on your assets. It's very difficult to not have a claim. You can push them to the end of the line. Junior claims, but it's still claims on the assets. Right? But you're trying to design the perfect bond. So that's what I want you to start with. Take your company, design the perfect bond from scratch. I know part of you screaming, you can't do this, you can't pull it off, it's going to be too difficult to do. For the moment, act like you can do it. Because the second stop you're going to make is to make sure, in fact, that you still get the tax advantage. You see what I mean by tax advantage? Basically, you've designed this very customized bond. Incidentally, in financial service companies, you have a version of this debt that behaves like equity called surplus notes. Have you heard of these? So this is the closest I can think to the bonds where you don't have a claim. Surplus notes, actually, you pay interest only if you have the income to cover the interest. And the reason financial service companies like surplus notes is some measures of regulatory capital treat surplus notes as part of equity. So they play that game, trying to keep different claim holders, different groups happy. So second stop in the game, you've designed this perfect bond. Stop at the tax lawyer's office. If you don't have one, find one. And make sure that what you've designed still passes the requirements to be debt. And it's at this stage in the process that you might massage the bond, add features to maximize tax benefits. Do you see what I mean by maximize tax benefits? Multinationally, you have a 40% tax rate in the US and a 20% tax rate in Europe. You want to try to move your debt so that it can be claimed against US income. You're going to do whatever you need to do to redesign the debt. And there are quirks in the tax law. For instance, if you issue zero coupon bonds, you know what you claim as an interest expense each year? You actually have to take the discount that you issue the zero coupon bond and amortize it over time, and sometimes that might give you a bigger tax advantage than actually issuing a coupon bond at a rate. So this is where you take the quirks in the tax law into account to kind of redesign the debt to maximize your tax benefits. So you've designed the perfect debt, you've got the tax okay. Incidentally, the tax lawyer can ask the IRS for a prior statement about whether the IRS will accept it as debt. The IRS will give it, but it will also say we're not bound by our own statement. So take it for whatever it's worth, but you can get at least some sense of, will this pass muster? So you've done the second stop. The third stop is a tricky one. If you run a publicly traded company, CFO or CEO of a publicly traded company, you have three groups to keep happy if you're regulated. So let's play the game. Let's suppose you're a Midwestern company, a small Midwestern company that's planning to make a security offering next week. Notice I didn't say what kind of security offering. So I'm going to leave that unspecified. You fly out to New York because you've got to keep these three groups happy. Your first stop is at the ratings agency, Moody's and S&P's. Now those are agencies that want you to reduce default risk. Remember that. So they want you to have. So what do they want you to issue? Debt or equity? They want you to issue equity because every time you issue debt increases your default risk. So in the morning at 9:30 you stop at Moody's, you convince them that the security you're going to be issuing next week is equity. You say, what's the big deal? Then you take a cab uptown to the Equity Research Analyst Conference. Now what do equity research analysts want you to issue? More shares or borrow money? Borrow money, because the minute you issue more shares, what happens? You have the dilution bogeyman coming out of the closet again, saying you can't do that. So you got to convince the equity research analyst that the same security this morning that you said was equity has now become debt. And if you're regulated, you have a third stop to make. All the regulatory capital ratios are built around equity. So you've got to stop at the regulatory agency and convince them it's back to being equity. Equity to debt back to being equity. So how can you pull that off? It sounds like a lie. You'd be amazed at how much work in corporate finance departments is designed to thread this needle. Be different things to different people. I'll give you an example. About 20 plus years ago, a banker at Goldman created the security. And I'm going to describe the security to you. And I want you to classify it into, remember we have only two buckets, debt or equity, and we use the criteria for classifying. Think about that criteria, deciding where to classify it. So this is what the Goldman banker invented. Security called trust preferred stock. It had a fixed dividend that was set up front. That fixed dividend had to be paid in good times and bad times, and it was tax deductible. Don't ask me how that happened. And if you failed to make the payment, you had to turn voting rights over to the trust preferred stockholders. You have a fixed dividend, tax deductible, and if you fail to pay it, you turn over voting rights. If I asked you which bucket should it go into, debt or equity, what does it look more like? That looks a lot like debt to me. And one of the great coups of all time, that Goldman banker managed to convince the ratings agencies to treat it as equity. I actually talked to one of the people on the original ratings panel that made this classification, because I didn't understand it when it happened. So I asked him, why do you do this? Why do you take something that looks like debt and allow them to treat it as equity? And he gave me two reasons, one incredibly stupid and one mildly stupid. I'll give you the incredibly stupid reason first. He said it was called preferred stock. See the opening he's given you? Let's go on a renaming convention on the balance sheet. Bank loans, we don't call them that anymore. It's bank preferred stock. Commercial paper, no, that's not it. It's commercial preferred stock. You can't go around classifying something as debt or equity based on what it's called. That's the incredibly stupid reason, in case you're wondering. Here's a mildly stupid reason. He said, trust preferred does not have a maturity date. Do you see where this is going? Traditionally, equity is the perpetual security. Debt usually has a finite maturity. He said, because trust preferred did not have a maturity, we decided to treat it as equity. What's wrong with that reason? What did I say Boeing and Disney issued in the late 90s? 100-year corporates, right? Let's assume you bought one of those bonds. Unless you're an incredibly optimistic person, you're not going to be around to collect the principal on this bond. See where I'm going next? Once you've gone 100, why not go 1,000? You're not going to be around anyway. Why not go forever? In fact, the Canadian, the British governments had bonds called console bonds that came with no maturity. They essentially lasted forever. So what if Boeing issued console bonds? You're saying, who'd buy that? Somebody will buy. The interest rate might have to be a little higher, but here's the bonus you're going to get. While you're issuing tens of billions of dollars of debt, what's happening to your rating? The equity ratings agencies are saying, that's equity, that's equity. Your rating is actually going to rise as you issue more debt. Neither reason really stood up to scrutiny. Ratings agencies eventually catch on. So this happened in the early 90s. Trust preferred was a huge security. So if you were hired in an investment bank in the early 90s, in their corporate finance department, there was a huge push on you to sell trust preferred to everybody who walked in through the door, including the FedEx guy. Would you like some trust preferred? Do you want to issue some? Because your commissions were huge on trust preferred. So let's say you're a low person on the totem pole. So you don't get to decide whether to issue trust preferred or not. You just have to sell this stuff. You're trying to create the least damage you can during your working lifetime. So I'm going to ask you, what type of clients, what type of companies are the best candidates for trust preferred, given that the ratings agencies are treating it as equity, but it's really debt? And I'll give you the choices. You can try to push it on firms that are under-levered. Remember, they have too little debt, but they're not going to their optimal because they have a rating constraint. Remember, we talked about companies not wanting to drop below a certain rating? So these companies are holding back because if they went to their optimal, the rating would drop. So that's the first set of clients you can sell it to. The second set of clients are companies that already have too much debt. They're over-levered, But you might be able to slip this by. Slip this by in the sense they might be able to get away with issuing trust preferred, and the ratings agency doesn't realize they've issued debt, so the rating doesn't drop. So who do you think is a better candidate for issuing trust preferred? The under-levered companies that have a rating constraint, or the over-levered companies that can slip this by? I think the under-levered make more sense, and here's why. If the over-levered companies issue trust preferred, they might fool the ratings agency, right? But why were they over-levered in the first place? Because they had a tough time making interest payments. That's what made them over-levered. Now what have you done on top of the existing interest payments? You've added trust preferred dividends you got to pay in good times and bad. You know what the only consolation price you might have is? You can go bankrupt with a really good rating. I don't know, maybe you can take that to the bank saying, look, I was a BBB rated bankrupt company. But you're going to go bankrupt. What I'm trying to say is this is not a game, and all too often it becomes a game of fooling the ratings agency. If we can get this by, look, we won. You haven't won anything. You have a really good rating, but ultimately the end game here is you want a going concern that doesn't have too much debt. And in fact, in the late 90s, here's what happened at investment banks. Every time the ratings agencies caught on, for instance with trust preferred, there was really debt. The investment banks would create something a little more complicated so that it would pass that test. And then the ratings agency would catch on the investment. So what they were doing is actually creating degrees of separation between a company and its own debt. I mean, if you normally borrow money, there's no separation. It's your debt. The bank knows you borrowed money. You know you borrowed money. But what the investment banks were creating is degrees of separation. And they were creating more and more degrees of separation by creating these complex securities. You keep doing this, you know what the end result is? You have Enron. I know we have the story of Enron being filled with unscrupulous, and that might all be true, but I can almost guarantee you that in late 99, if you'd walked into Andy Fastow's office at Enron and asked him, how much money do you owe as a company? He wouldn't have known the answer to that question, because they'd created so many special purpose entities, so much separation between the company and its own debt, the company did not know how much money it owed. And that's a really dangerous place to be, is to run a business and ask you, how much do you owe? And say, I don't know. It's separated in a special purpose entity. That's, I think, where you want to avoid being. You want to always step back, even when you're designing these complex financing transactions, and ask, am I creating something that this company can survive with, can be a going concern with? Because that's your end game, not fooling other people in this process. So this stage, here's what we have. We've designed the perfect debt. We've got the tax okay. We've got these three groups of people, stockholders, ratings agencies, and regulatory authorities, maybe not all applauding, but none of them is really pissed off at you. You get to the fourth stop in the process. You get ready to issue these bonds, and nobody will buy your bonds. You're saying, why not? Because you have a history. Or you have no history at all. Let me back up. If you're trying to issue bonds and you've never issued bonds before, people might not trust you because you have no history with the bond market. So the first time a company issues bonds, it's always more difficult to get investors to buy. Or you have the wrong kind of history. You've been issuing bonds for a long time, but you've done bad things to bondholders. I'll give you an example. We talked about Nabisco in one of the early classes, where they Nabisco'd their bondholders and screwed them over, and they lost 25%. Nabisco became a private company after that LBO for about 5 years, went back public, and in 92, 6 years after they'd Nabisco'd their original bondholders, Nabisco tried to issue bonds. And guess what happened? Nobody would buy their bonds because they remembered. Bond markets have much longer memories than equity markets do. Equity guys, you can keep doing the same thing every year and a half. They've forgotten everything from the previous fiasco. Yeah? Nobody would buy the bonds. So if you're in that position of a company that is issuing bonds but people don't trust you, you've got to sugarcoat the bonds. You've got to give these buyers some protection from you. So here's some of the sugarcoatings you can add. You can make the bonds convertible. You see how that helps people buy the bonds? If they're worried that you might rip them off, that you as equity investors will rip off the bondholders, by adding a conversion feature, you're essentially saying, if I rip you off too much, you can become one of us. That's basically it. You add that conversion feature. You can become pretty creative. You can make bonds puttable. Remember post-Nabisco, that's exactly one reason most of these bonds became puttable, is essentially to let bond buyers say, look, if you don't like what we're doing, we do leverage buyout, you can put the bonds back and get your face value. In fact, Merrill Lynch invented these bonds called rating-sensitive bonds. And what they did was the coupon rate on the bond was tied to what your rating was. Because remember what the Nabisco problem was. You bought the bonds when it was a AA rated company. It became a BB rated company, but your coupon rate stayed where it was when it was a AA rated company. If you'd bought a rating sensitive bond, your coupon rate would have adjusted to your rating. You're not doing any of this stuff because you want to. You're doing this because if you don't do this, guess what will happen? Your bond buyers will set a very high interest rate because they don't trust you. This is your way of saying, I know you don't trust us, but we're going to give you enough protection that you buy these bonds. So here's where we are. You've designed the perfect bond. You've got the tax okay. You've got these different groups, equity research analysts, ratings agencies, and regulatory authorities, okay with what you're doing. You've sugar-coated the bond just enough to make it acceptable. You get ready to issue your bonds. And there's one final question you've got to answer. Are there mistakes built into the pricing of your bonds, into the risk assessment in your bonds, that you don't want to lock in for the long term? And let me back up and explain. Let's assume that you're a rated company. The ratings agency has given you a BBB rating. But you believe, based on your financials, you should have a AA rating. You think the ratings agencies have underrated you. The right bond for you, based on the kinds of projects you take, is a 30-year fixed rate bond. You know why you shouldn't issue the 30-year fixed rate bond today? If you issue it today, what's going to happen? People are going to see a BBB rating. They're going to set an interest rate based on the BBB rating. You're paying too high an interest rate given your risk. So here's what you might want to do. Issue short-term debt even though it's not right for you. Then try to get the ratings agencies to change their mind. Maybe offer them more evidence. It might not work, but you don't want to lock in market mistakes that work against you. Here's a tougher question. What if there's a market mistake in your favor? What if you should really be BBB rated and I gave you a AA rating? You're going to lock it in. You're going to borrow more money than you ever need. And in fact, this is actually one of the most difficult problems to confront in corporate finance. What if the market is overvaluing your debt or your equity? This morning I was reading in the New York Times, I don't know if it was one of these interviews with the CEO of a young technology company. And he said, this is like Christmas. We can raise as much as we know that people are giving us equity at terms that we shouldn't even be seeing. And then he said something that I thought was very honest because most people don't say it. He said, we don't even need the money, but we're going to go out and raise as much equity as we can because if somebody is willing to offer us $160 million for 5% of our equity, we know it's way too much. I'd be doing a disservice to my existing equity investors to not take the money. And that's actually a problem a lot of technology companies are facing right now. If you're the CEO of, I don't know, Box or Shake Shack, the question you face is, I don't need the money, but should I go out and raise the equity right now? And everybody's all optimistic about me. And it's a tough question to answer because here's why. If you go out and raise the equity today, at a price you know is too high, you're effectively transferring wealth from the new investors in the company to the old investors, right? You think, so what? After the equity issue, they're all investors in your company, new investors and old investors. And if you're not careful, if you keep doing this, the people you are ripping off might actually outnumber the people who are actually benefiting from being from the rip-off. And at some point in time, you're the CEO, you're going to be facing up to these stockholders once the correction happens, and how are you going to explain it to them? I know it's tough to do, but even if the market is overpricing you, my advice to CEOs, if you need the money, there's nothing ethical about going out and raising the equity. The market's making the mistake. But if you don't need the money, don't go out and raise more capital than you can because it's not a question of just making your stockholders better off. You're making them better off at the expense of new stockholders who are coming into the company. And that's not a place you want to be as a CEO. You have a question?
You know, just a long-term perspective.
The long-term effect, that's what I worry about, and in fact, I'll tell you, in the late 90s, this rating story played out with a lot of telecom companies that were overrated. They went out and issued debt like it was going out of style. They got all this cash that they did not need. And here's the danger of having a lot of cash you don't need. It starts to burn a hole in your pocket. You know what you do next? You do really stupid things with the cash. That's what I worry about as well, is you're taking advantage of the market, but then if you just let the cash sit where it might not hurt you, but you don't. You start to do stupid things with the cash, and that's when I think you really do damage to all your stockholders in the company. So if you really need the capital, it doesn't matter whether the market's overpriced or underpriced, you have to raise it at the market price. But if you don't need the capital, don't make this a game of transferring wealth from new stockholders to old stockholders, which unfortunately is what's happening at a lot of young social media companies. Does Uber need another $3 billion in cash? Does Lyft need another $1 billion in cash? I don't know, but they seem to be raising capital like it's going out of style, selling small piece of the company. And that's, if they truly believe that they're undervalued at that price, fine. But if they're doing this in spite of believing that the market is overpricing them, then I think we're in a dangerous place. Any questions? So it's a 5-step process, and basically I've just compressed all 5 steps. Don't even try to read this from the previous 5 pages. I've tried to put it into 1 page. So start off by designing the perfect debt. Check it out against the tax laws to make sure you're passing all the rules. And if there are market frictions, you might have to adapt. Make sure you're keeping these different groups reasonably happy. Sugarcoat the debt, and make sure you don't lock in market mistakes that go against you. So what I'd like you to do when you start on your company is to start thinking through this process. If I were designing the perfect debt for my company, what would it look like? So what I'm going to do is try to operationalize this using Disney as my example. And I'm going to take you through 3 ways in which you can design the perfect debt for your company. First, and this is the way I'm going to draw on the most, is purely intuitive. It's purely qualitative, where you look at the typical projects for your company and you try to design what kind of debt is right given those projects. Right? The second approach works when you have one big project. I'll give you an example. Disney is going to build a big theme park in Beijing, or that Rio Disney theme park we did. If you said, I want to finance a project, this is project financing as opposed to company financing, what would I do differently? Again, I'll set up a framework for designing the perfect debt for a big individual project. And thirdly, I'm going to use historical numbers on earnings and market cap and value to try to eke out some evidence on what kind of debt would be right for your company. And you're going to be surprised at how much you can learn by looking at the past, especially if you have a company with as much history as Disney. So let me start with the first approach. Right? As I said, for Disney, there is no one typical project because it's in 5 different businesses. So with each business, I tried to come up with a typical project, and I said, if this business was standing alone, what kind of debt should I use? So let's start with the movie business. You've probably been reading all those news stories about the next Star Wars movie that's in the works. Okay. For 2 years out still, a year and a half out here. But let's say 2 years ago, LucasArts was a standalone company trying to finance the next Star Wars movie. It's much more, I think, critical that you match that up when you're a standalone company, because Disney has the benefits of being able to diversify across these businesses. But let's say you're a standalone movie company. Right? Classic example would be Lionsgate, designing debt. Your debt is going to be tied to the next what's the next one coming out of the Hunger Games? Whichever the next episode is, you decide to finance it. So the project is typically short-term, 2 to 3 years. Second, the cash outflows, at least for Disney, are primarily in dollars, but increasingly Disney on its movies has an international audience. I think The Avengers was the first Disney movie that was released on the same day outside the US as it was in the US. So your inflows are increasingly in multiple currencies. And here's the feature about the movie business that makes it unique. At the end of every summer, they'll release the list of the 10 biggest grossing movies of the summer. Every summer that I watch this list, those top 10 movies will account for about 85% of the gate receipts for the entire summer. There might be 100 movies over the summer, but the top 10 account for the remaining, for 85%. The remaining 90 account for 15%. This is why when you go on Netflix and you look up movies, you say, what? I've never heard of that movie. Because there are movies that come and go. You don't even notice them. There are a lot of movies that lose money. But if you have a winner, like Hunger Games, it can make you tons of money. Frozen. So the movie business is a very skewed business. It's not where 80% of the projects win and there's a few movies win big, and they win really big, and a lot of movies barely make it. You think, so what? I wanted to design a perfect bond for a movie company. So first, it's got to be short-term debt, right? Why? Because movies are short-term. What currency should it be in? Depends on what kind of movie you're making. If you're making an artistic movie that only people in the US and Europe might watch, the kind of cash flow breakdown in your debt might be very different than you make an action movie. Action movies actually make more money in Asia than any other movies made in the US, because people don't care whether they understand what's being said. Furious 7, you could have just put, you could listen, you don't have to listen to a word of the conversation, you kind of get the movie, right? There are cars flying around, there's people people flying all over the place. Who cares about the conversation? It travels much better. So you tell me what kind of movies you make, I can tell you what the currency breakdown should be in. But here's the feature I'd like to add to your bonds. If you're Lionsgate, you're saying, how should I fund the next Hunger Games movie? We know the first 2, 3, whatever's have come out have been very successful, but we don't know whether the fourth one is going to be as successful. And you worry about it. As Lionsgate, if you go out and borrow a lot of money on the next Hunger Games episode, and it doesn't work out, you could be in trouble. So you tie the coupon rate on the bond to what your gate receipts are. So your gate receipts exceed $500 million, you're willing to pay 12%, and you can afford to pay that. If they're between 300 and 500 million, your coupon rate is set at 8%. If it's 100 to 300, it's 6%. If it drops below 100, you'd like it to be 2%. See, who would buy a bond like that? As I said, you'd be surprised at what people will buy. Have you ever heard of Bowie bonds? You remember David Bowie? Got the spiky hair, strange character. Early 90s, he had a fight with his record company. And he bought back the rights to all of his music, which left him with a cash flow problem. Rock star, cash flow problem don't go together. Now, who'll maintain the 5 houses and the 3 roads and whatever else he had? So here's what he did. He approached a banker in New York who actually issued bonds against the future revenues from David Bowie's music. And what made Bowie bonds unique was the coupon rate was tied to how many records he sold. These were the days before iTunes. So if he sold a lot of platinum records, the coupon rate was going to be as high as 15%. If tomorrow we all woke up and said, David Bowie, I don't know what he's singing, horrible singer, nobody buys his music, the coupon rate actually dropped to 0%. If people will buy Bowie bonds, I don't see why they wouldn't buy Hunger Games bonds or Star Wars bonds or Madonna bonds. They never mature. So basically, you can basically take any stream of cash flows and issue bonds. In fact, to show you how much people can tailor this, there was an Italian soccer team, I don't know the name of the team, that had dropped from the first flight to the second flight in Italian soccer. And they were building a stadium. And they were issuing a bond to finance a stadium. You know what your nightmare scenario is, right? You'll stay in the second flight, you build all this big stadium, you borrow the money, and if you never make it back to the first flight, you're in trouble. So you know what they did? They tied the coupon rate to whether they made it back to the first flight. If they made it back to the first flight, the coupon rate was high. If they made it if they stayed in the second flight, they had a much lower coupon rate. Again, you're not pulling a fast one. The market interest in your bond adjusts to what you've designed the bond to do, but you're doing it to protect yourself against default. So that's for the movie business. Let's look at the broadcasting business. Typical project in the broadcasting business is going to be short-term in terms of getting it started, but if it's one of those shows that goes on and on and on, it could become an 8 or the length of the project can actually vary depending on how successful the project is. Okay? For Disney at least, it's primarily in dollars. Most of the Disney TV is primarily in dollars, but that's starting to change. They're starting to go after the Spanish market, the Latin American market. No, they're trying to but it's still. Yeah. And for ESPN, it's again primarily US still, but it's starting to expand outside. And it's driven by ratings, right? Not bond ratings, but by TV ratings. And Nielsen ratings, basically. So if you could issue a bond as a broadcasting company, you'd like to tie the coupon rate on the bond, if you could, to how well the TV show does. This morning I was reading about how Netflix is increasingly moving to original content. I know a couple of people in this class are doing Netflix. It's changing the business, right? Because historically they've been a streaming company. They take other people's content, they stream it, they collect a little money in the middle from you and I. But as they move to Orange is the New Black or whatever the new shows are, they're facing a different process. It's costly to make these shows, and they might have to borrow money to fund these shows. So this is an issue they're going to face. How do we borrow money to fund a show? Well, we're not sure whether the show will make it, but if it does, it could make us a lot of money. And I think they need to start thinking about ways of linking their interest in coupon payments to how well these shows do. Theme parks. This, if you're looking at any of Disney's businesses, this is the business that's most likely to be really long-term. We talked about the 100-year bonds. This is the only business that I can think of that Disney has where a 100-year bond would make sense. After all, Disneyland is, 60 years old almost, and it's still going strong. What currency your cash flows are in will be where the park is located, but that's kind of misleading because everybody who comes into Disney World in Orlando pays in US dollars, right? Saying, I don't care about exchange rates. But do you? Do exchange rates still affect you? Yeah, if the real gets weaker, there'll be far fewer Brazilians coming into Orlando. So in a sense, even though you collect your revenues in dollars, you're affected by what happens to exchange rates. So if you were issuing debt for a theme park, it's going to be really long-term because these are long-term investments. But the breakdown of currencies that you use for the debt should reflect where your tourists come from. So you look at Orlando, it gets a lot of Latin American tourists. You look at Disneyland, it gets a lot of Asian tourists. My suggestion to Disney, if they're funding these theme parks, is to use that mix in deciding what currency to use. And consumer products basically are, for Disney at least, is increasingly licensing. We talked about the 3 million frozen dresses. Disney used to actually be in this business, but they've decided that being in this business is not worth the pain because you've got to keep track of, garment manufacturers in Bangladesh and basically say, we don't want any of that. We're just going to license it out to other people and let them deal with the consequences. You think, so what? If your consumer products are predominantly licensed and your license revenue is a fixed number, basically you set it up front, 5 million a year for the next 15 years. First, you can borrow a lot more than you used to be able to borrow. And your bonds should reflect the nature of those licensing revenues. So if you told me you have a consumer product business, those are the questions I'm going to ask you. Do you have that risk of revenues going up and down, or have you licensed it? Because your answer is going to determine the right kind of debt for your company. And of all of Disney's businesses, the riskiest is their interactive gaming business. If it were a standalone business, first, it can't afford to borrow much money. And if it does borrow money, it's going to be Tesla like that. A lot of convertible debt because you really can't afford to make those coupon payments right now. Now, one of the advantages you get if you're at Disney is you can screw up on your debt design collectively as a company and things can average out. But if you're a standalone company in each of these businesses, it becomes much more critical that you match up your debt to the kind of cash flows you have on your assets. So what I'd like you to do, and this can be done even without doing the earlier parts, is take a look at your company. If you're lucky, it'll be a single product company, a Coca-Cola or a Boeing, and you can design the debt pretty quickly. If it's a multi-business company, think about the businesses there and think about a typical project in that business and think about designing the debt that matches up to the project. Incidentally, what's a typical debt that retailers use? How did most retailers borrow money? We talked about this. I'm sorry? Oh, the consumers use credit cards, but retailers, to open a store, they tend not to borrow money and buy the store. They lease the store. You see why leases make sense for retailers? Each debt is tied to a business with the option that if the store does really badly, you have an escape clause in the lease. It is the perfect debt. There's a reason why leases have evolved as the typical debt for retailers because it makes the most sense. So when you look at your company and see how they borrow money, that's something to factor in. Is, sometimes history gives you a suggestion as to what you should be using as the right debt for your company. So when you get a chance, just at least at a very general level, think about what the right kind of debt for your company should be. Don't look at what they actually have because it might not match up. And that's the reason you do this analysis, is to see if there's a mismatch between the debt they have and the debt they should have. So that's that's the intuitive analysis. There isn't a single number I drew on, but I drew on what I knew about each business. Here's the second task. Let's suppose I came to you with a specific project. This project has to be pretty big and a standalone project for me to do project financing. Let me explain. If I have 100 movies I'm making as a company, it doesn't make sense for me to take each movie and try to match it up to the best kind of debt because I have a portfolio of investments. But if Disney is building a huge theme park, a multi-billion-dollar theme park, I think it makes far more sense to think about, can I design debt that's right for this project? So let's go through the process of designing the perfect debt for Rio Disney. Remember the theme park we did the capital budgeting in? We decided that it was a good investment for Disney, right? So Disney agrees. They say, okay, we're going to build Rio Disney. I'm going to try to design the perfect debt for Rio Disney. So one of the first questions I've got to look at is, how long-term should my debt be? And the answer at a qualitative level is pretty easy, right? It's a really long-term investment. Your debt should be really long-term. But let's say I want something more specific. I actually remember those cash flows I used to analyze the project? I went back and got those cash flows and the terminal value. There's my traditional present value, where I just took the cash flows, discounted them back at the cost of capital, 3.3 billion. That was what we originally came up with as net present value. I added an extra column. And here's what I did in the extra column, and try to see whether you can think about something somewhere else. You might have done exactly this in a different form. I took the present value and I multiplied by when the present value came in. So the cash flow in year 0, because times 0 becomes 0. Cash flow in year 1 minus 922 times 1 is minus. So each year's present value I'm multiplying by when that cash flow comes in. So it comes in 5 years, I multiply the present value by 5. I add up those numbers and I come up with 62.355 billion. I divide the 62.355 by 3,296. I come up with 18.92. I don't know whether you remember in Foundations of Finance this concept called Macaulay duration for a bond. You remember duration of a bond? I know you don't. Act like you do. This is what you do with the Macaulay duration, is you take each coupon, you take the present value, and you multiply that present value by T, and you come up with the duration of a bond. I've actually taken the project as a collection of cash flows and computed the duration for this project. You're saying, how does this help me? Remember the question I'm trying to answer. What type of debt? How long term should my debt be? If I believe this duration number, which is about 19 years, you know what that's telling me about the debt that I should be issuing as Disney? Its duration should be roughly 19 years. Does that mean the maturity should also be 19 years? No, it'd probably be longer, because remember, when I have a coupon bond, the duration of that coupon bond is going to be much lower than the maturity. A 35 or a 40-year maturity bond is going to have, roughly speaking, a duration of roughly 19 years. If I have a big standalone project, in an optimal world, I'd like my duration on my debt to be roughly equal to the duration of my assets. Now, if I ask you a follow-up question, 19-year debt, okay, what currency should the debt be in? Finish the process. It's a Rio Disney. The cash flows are all in reais, but what's the next question you need to ask? Where are the people coming from? And if I say 70% from Brazil, 20% from Argentina, 10% from the rest of Latin America, I'm going to think about designing the debt to reflect that. The 70% will be in reais, 20% in Argentine pesos, 10% might be some generic currency. You might decide to do it all in reais still. But basically, the cash flows on the debt should try to match up to what's driving the cash flows on my asset. I know lots of little tedious steps, but if you step back and think about what we've talked about all through today, it's about trying to design that debt that behaves like equity. The cash flows kind of increase and decrease as your cash flows as a business increase and decrease. So if you were designing the perfect debt, that's what you would design. So I know some of you might end up working in project financing. What makes project financing different from company financing is if it's a standalone project, you can't draw on the good stuff the company does. You basically have to look at what's right for this project and try to design the debt for that project. Okay. Any questions on designing the perfect debt for a project? Which brings me to the third and final way in which I can design the perfect debt for a company. Remember, the objective here is I want to design debt that reflects what happens to your company. So if I have a long history for your company, I can look at what your earnings have done over time and your value as a company has done over time, market value as a company. And I can collect data on macroeconomic variables, interest rates, inflation, economic growth. I can try to back out from the data how sensitive you are as a company to changes in inflation, to changes in interest rates, to changes in economic growth. And if I can do that, I can design debt around what I find. So let me take Disney, where I have a long history, and see if I can extract from that history some information that I can use to determine what the right debt for Disney should be. I was able to go back all the way to 85 to 2000, so that's 28 years of data. I collected the operating income, or the earnings before interest and taxes every year. Incidentally, if you get on Bloomberg, you can pull this off for any company for as far back in history as data is available. So it's the easiest way to collect the historical data. I also collected the enterprise value every year. Remember what the enterprise value is? Market cap plus debt minus cash every year. So basically you can see there are good years and bad years in both. I computed the percentage change in operating income and the percentage change in value. You see what I'm laying the foundations for? I'm trying to figure out what have been good years and bad years for Disney over the last 28 years. Once I have this, here's what I correlated that to. I collected 4 macroeconomic variables. The T-bond rate every year, how much the GDP changed each year, what the percentage change in the CPI was, and what the percentage change in the dollar. Let me back up and explain why I picked these 4. I want to see how sensitive Disney is to changes in interest rates. When interest rates go up, is it bad for Disney? If so, how bad? I want to see how Disney is relative to how the economy is doing. When the economy is doing well, does Disney tend to do well? When the economy is doing badly, does it tend to do badly? What I'm trying to get past is the storytelling we often say. Let's see if the data backs up. So if you tell me Disney is a cyclical company, you know what I should find? When I take the percentage change in income and value for Disney and I look at it relative to the percentage change in GDP, I should see that when you have really big positive changes in GDP, I should have big changes in operating income. The percentage change in CPI looks at inflation. What am I trying to capture there? If I told, do you think Disney has pricing power as a company? Oh, it's lots of pricing power, right? And if that is true, what should we find? As inflation goes up, you should see earnings go up. As inflation goes down, you should see earnings go down. And finally, we talked about how Disney can be hurt by a stronger dollar, right? That last column is the percentage change in the weighted US dollar. What that is, if you go to the Federal Reserve site, it's a because you can say dollar, euro, dollar, but each currency is different. What they do is they take a trade weighted dollar, which means they weight each currency by how much trade the US has with that currency, and they take a weighted. So think of it as kind of one number that captures whether the dollar had a good year and strengthened or weakened. And again, I'm going to try to see whether when the dollar gets stronger, it's bad news for Disney, and if so, how bad it is. So I have 28 years of data on Disney. I have these 4 macroeconomic variables for the 28 years. I'll set up the process because we're almost at the end of class. Here's the first thing I'm going to look at. I'm going to look to see whether Disney's operating income and market value is sensitive, and if so, how sensitive it is to changes in interest rates. I'm going to argue that knowing the answer to this question is going to let me design the maturity for my debt, how long-term my debt should be, and how much debt I should take on. So when we start off on Wednesday, that's what we're going to start with, is this regression between Disney's value and interest rates, and back out from it information about what the right maturity for the debt for Disney should be. Okay. The next quiz will actually cover only through the end of capital structure. So almost to the end of the section we will need for the next quiz. We actually have 9 days until the next quiz. So essentially, if you want to start preparing now, you're almost there. So I'll see you on Wednesday.
Question. I'm doing Shell for my project and they pay taxes in various countries. So what should I take as my marginal tax rate?
Just use the UK.
You can
Were you looking at the London listing, or
the London list.
Just use the UK.
Until last class, we were always saying that we should take the debt in the currency where the tax rate is the highest, maximize the value. But this class we did say that it's all about the currency.
Well, if you mismatch the debt, then basically you'll have to figure out some other way to get back in the match. If you decide to borrow everything in the US and you get 60% of your revenues in Europe, you might have to use forwards or futures. So there are lots of ways you can get the match. If you use that might give you a bigger tax benefit than borrowing in euros or borrowing in rupee or borrowing in yuan. If you borrow entirely in the US, but then you forward and do it.
So my company should think about how my company is Irish.
When you do the perfect debt, act like the second step when you stop and ask, what does give me the maximum tax benefit? You might say, well, even though this is the right match, the best way for me to get there is to issue all my debt in the US in dollars and then get rid of that mismatch with these forward futures. Well, you're the individual country, right? On my website, the individual countries, your screen is you just take a weighted average by region. No, GDP. I also have the GDP in that the same spreadsheet. I say it's GDP. So basically, I actually have right now. I have the North America and South America. You just take the GDP of North America times North America, which is US and Canada, 5.75%. You take the GDP of the rest of the Americas, which I get, and multiply by the weighted average for the rest of America, you get an American. I right now have Middle East and Australia as separate, but I also have the GDPs for each. You take a weighted average based on GDPs, and you have a weighted. So go to that spreadsheet which has my country risk premiums. You'll have both the risk premiums by country and the GDPs by country, the risk premiums by region and the GDPs by region. Just try to create a GDP.
So doing that with revenue, then I'm assuming that the revenues
are proportional to the GDP, which is probably not that far from the truth. You're going to get the US is 80% of the Americas, and the revenues are probably 80% of the US.
Okay.